Most of the deals you go in all cash, no mortgage, and you're not leveraged?
Not leveraged. And that is not flexible.
Wow, I like
The
this.
set in my documents. Bought 5 deals in the past year and a half, and one of them has a 30% mortgage, and the other ones are all debt-free.
Wow, I like this.
I'm really excited to have Joel Friedland with us. He is an industrial real estate syndicator with over 40 years experience and nearly 100 acquisitions in the Chicagoland area, totaling about 3 million square feet. He has over 200 investors and has a very unique philosophy when it comes to debt ratios and preservation of capital. And we are going to dig into all of that. Joel, welcome to the Passive Investing from Left Field podcast.
Hey, Jim, it is great to see you.
Well, thanks for being on. And the first question I always ask is if you could just kind of give your backstory. How did you get into real estate? Why did you decide to get into industrial, and why Chicago? So if you can kind of tell us how you got here, and we'd love to hear it.
Sure. When I was 22 years old and I had graduated from the University of Michigan, which, by the way, just won a big game 2 nights ago. Very exciting. My path that I was pursuing was to get into real estate, but I didn't know what industrial was. And I was introduced to a family that owned 6 million square feet of industrial properties in the Chicago area. And they hired me literally on August 22nd, 1981. It was the first day I was looking for a job. I met them, I interviewed, and I started. And that was 1981. Now, I was 22 years old. Interest rates were 17%, and the recession was terrible. Companies weren't moving. And my boss, Steve Podolsky, had 84 buildings, and 10 of them were vacant. And my job was to go fill up the vacancies by cold calling in industrial parks and finding tenants.
Wow. Sounds like fun.
Actually, I found out that I could do it. I didn't know if I could do it or not. But Mr. Podolsky said, I want you to get in your car and drive to our vacant buildings. I'll give you the addresses, and just stop in and talk to all the neighbors and see if you can get them to move into one of our buildings. And that's what I did. It was really fun. It was fun. You probably haven't heard anybody say cold calling's fun, but when you do it in person and you're in an industrial park, every company's different. Each company manufactures or distributes a different kind of product. And I'd walk in and I'd get invited into the owner's or the president's office almost every time, because who does that? And I'd sit and listen to their story about their family business and how grandpa started the company manufacturing some kind of parts that went into cars, and they went into aerospace, and how now there's all these family members. And each meeting was cool.
Wow. And then, so where did you go from there? So I assume you filled those 10 buildings and your boss was pleased. And then did you decide to become an investor, or were you just kind of an employee and eventually became an investor?
Well, I was an employee because they had a brokerage company. And so not only did they own properties, but they had their own leasing side. So I was working with about 9 or 10 people who were on the leasing side for them. And I became an industrial real estate broker. And for 10 years, I worked for the Podolsky family in the Chicago area, where, by the way, we have 16,000 industrial buildings, which is a lot. There's 3 top markets in the country. Chicago is one of the top 3. It's debatable whether it's the number 1 best. But the reason Chicago is so great is because it's a huge population center, and because it's the place where rail and where all the highways converge in the middle of the country, and because of the fact that there's natural fresh water, which is really important, especially for food manufacturers. That doesn't happen everywhere in the country. We've got Lake Michigan, and the water just comes from these giant pipes to all the buildings. So Chicago is really a fantastic hub for industrial. And so I brokered. I made, no joke, 2,000 industrial real estate deals over the past 40 years. I still do brokerage for clients that have been with me for a long time, and I'm 64. So for 42 years, I have 2 clients that have been with me the entire time. One's called Eli's Cheesecake, and the other one's called the Bradford Exchange. And if you can imagine having a client for 42 years and doing all of their leasing and all of their construction management, overseeing additions to their buildings and renewals of their leases. And in between, I've done deals with all kinds of manufacturers and distributors and service companies. It's been really fun.
And so where is that now? So you transitioned away from just being a broker to owning a business, being an operator where you're buying properties for your own account, and then I assume you're renting these properties to the manufacturers or whoever. Can you kind of explain where you are now and what the business is like?
Yeah, first of all, the answer is it was extremely hard to make the transition, because when you're a broker, you're not putting money into anything. You're putting your time in. And after 10 years working for Steve Podolsky, who I love and I see still a close friend of mine, I realized that he and his family were wealthy not because they were brokers, but because they had acquired and syndicated millions and millions of dollars of real estate. And so they weren't inviting me to be a syndicator as part of their family. They were saying, you go lease our buildings and bring us commissions by doing third-party brokerage, where you can represent tenants as a tenant rep and landlords as a landlord rep. So the reason I did all those deals is because I built up a huge group of relationships in brokerage. But when I wanted to do my first acquisition or syndication, I didn't even know where to start. I was completely stymied. And I was just like pulling my hair out, and I was trying to figure out, how do I get started buying? There's such a barrier to entry when all I know how to do is introduce party A to party B and make a commission. So I had to start somewhere. So I went to the Podolskys and I said, will you help me learn how to be a syndicator? And they said, you go find a building and we'll put up 1/3 of the money and we'll introduce you to our investors, but you need to bring them into your deal. We're not going to sell your deal for you. And then you need to bring in at least 1/3 of the money from your own people and yourself. So I found an opportunity, and we did a $560,000 deal in 1989. And we raised money at $20,000 per clip. So you can imagine that's a lot of people for 560,000. You know, we had to raise money from 20 something people, and the Podolskys were true to their word. They put up 1/3 of the money, and we leased the building. We bought a vacant building. We leased it. And then within 6 months, I decided, hey, this works. I can do this. And with their help, again, I went and did the second one. And that was a $2.7 million deal, which is much harder. Really hard. You know, I was 30 years old and I was raising all this money and I had never done it. And I had to find this other deal. So the next one was in Aurora, Illinois. We had 2 buildings there next to each other. We leased one to Maytag. And at the time, they were famous for having the repairman that had nothing to do.
Right.
I don't know if you remember those ads.
Sure.
And we leased another one to an office furniture company. And it was really a difficult time, because when I started was when the Gulf War occurred in the early 1990s. That's when I had done my second deal. And every time there's something that happens terrible in the economy, real estate gets very tough, like right now.
Right.
When something happens, whether interest rates are high or whether there's a war or whether there's a recession. And I learned that it's very difficult to raise money and to do deals when bad things are happening. I kept doing it, and it became easier and easier as the economy got better and as I had a track record. And ultimately, I left the Podolskys organization to start my own company with 3 other people who were doing industrial. And the Podolskys continued to be my friend and continued to invest with me. I left on really good terms. But since then, I've done another 90 acquisitions: Florida, Ohio, New York, and Chicago.
Okay.
Yeah.
So, but your focus is still Chicago for all the reasons that you've given, or is it kind of branching out now, or did you branch out and then realize Chicago is the best place to be and you came back?
Yeah, I branched out and then I realized I don't need to get on an airplane and go to somebody else's market when I know the market here as well as anybody in town. I've got this laser focus on the industrial market here. As I said, there's 16,000 buildings. There's 1.5 billion square feet, which is huge. There's enough to do here. Every day the market changes just enough that I don't know everything every day. The next day it's different than it was the day before. And so my group and I are immersed in the Chicago market. We need to track everything that happens so that we are the market experts, because we don't want to be fooled and do something stupid and buy the wrong building in the wrong market for the wrong reasons. So I don't want to go to some other market and figure out their market where someone's the Joel of, let's say, Nashville or the Joel of Dallas. I'm going to go there and there's going to be someone who has 40 years of experience, and I'm going to try to learn the market and figure it out and make something work. So I've learned that I've got the parking lot theory. You can, if there's a parking lot and all the spaces are full, you can drive around and around and around, or you can just park in one aisle and wait for someone to pull out in that aisle and you're the guy that gets the space. So I'm the parking lot theory guy. And so I'm just watching this market like I'd be watching an aisle in a parking lot, and I know everything that's happening in that aisle. So we're right down that alley of Chicago industrial, and it gets so specific, Jim. Only infill, which means either in the city or near O'Hare Airport, nothing way out in the far out suburbs, for a variety of reasons. It's really important. And we also only do small deals that, let's say, are under 100,000 square feet, which is small in our world, because I don't want to compete with pension funds that have unlimited money and they just will build these giant buildings that, when things go bad, they sit vacant for a long time, and my investors and I cannot take that kind of a loss.
And talk about, investors typically, I like to diversify by operator, asset class, market. How is it that you are so hyper focused not only on a niche asset class in industrial, but also a market that isn't really common for syndications in Chicago? Mostly it's in the growth states. And then you're also concentrated on just very specific areas within Chicago. So can you just talk about that concentration of risk and how you deal with that as a company?
Yeah, sure. There are 3 or 4 syndicators in Chicago who do industrial. So I'm not the only one. It's such a big market. It's so vast that there are others who do it. And of the 4 of us that do it, we're the smallest. And we have this niche, and our niche is buildings of between, let's say, 10,000 square feet up to as big as maybe 45, 50,000 square feet. And the reason that we like those buildings and that's our niche is because there's a plethora of tenants for that size, and there's even more interested buyers for that size. So what we do is this is our model. We buy these buildings that are generally leased by companies that manufacture products. I'll give you some examples of this. And we buy them from families. So the industrial world is full of companies that were started by grandpa like 50 or 80 years ago, and in some cases great grandpa. And the family members join the company as they get older. They graduate from college and they don't know what to do, and they go into the family business. And then 2 brothers are in, and the 2 brothers have kids. And now all the grandchildren have to figure out if they want to be in the business. So the model is this. We find buildings that were previously occupied by the company that was the family-owned business. The way that this works, the process works, is the family ends up fighting with each other or not wanting to be partners with each other in the building anymore. They sold the business to a private equity group. And then the private equity group stayed in the building and leased it back from the family. So 9 out of the 10 deals that we do is we buy buildings from these very, very wealthy families that just want to get rid of them, where the tenant in the building is the company that they used to own that's now owned by somebody bigger. And we lease the buildings to those companies and they stay and stay and stay. We call them sticky tenants because they have so much equipment and they have employees who are used to being there because that's where they've always come to work, and the companies can't afford to move. So many of our buildings, we have tenants that have been there for 18 years, 25 years, 30 years, and they keep renewing the lease every time the lease comes up every 5 or 7 years. And that's what our portfolio looks like.
And are these triple net leases, or can you talk about what you're responsible for and what the tenant is responsible for?
Sure. Let me give you our pro forma. We want an 8% return starting day one. So we buy all cash, no mortgages. And if we buy a building for $1 million, we have to be getting $80,000 a year in rent because our investors like to get 2% a quarter. We distribute quarterly. Really important that we have that, the pro forma of the 8%. And one of the biggest things that I find in terms of our syndications is that we have all these people like who like to put in a small amount because they like to diversify. So we have $50,000 investors, we've got $100,000 investors, but believe it or not, we start with $25,000 and we're very happy to get investors with $25,000 to learn about us and for us to learn about them. And we, as I said, we don't do any debt on most of our deals because we are so risk averse. Because here's the problem with industrial. If a tenant moves out of a 20,000 foot building, it's either fully leased or it's fully vacant. And when they leave, it's fully vacant. And we don't want to have to pay a mortgage and have a lender breathing down our neck. So that's sort of how we put our deals together.
Now, is that common with your competitors, say that the no debt? Because, it certainly is risk averse, especially if someone moves out. But on the other side, when interest rates were super low, you're missing out on that leverage. So you're not able to, get those bigger returns. Was that a problem or an issue for you when the interest rates were so low that everybody was levering up?
No, we are in a very special niche. I think we're the only group in the country that does all cash deals like this. I don't know anybody else who does it. And the reason we do it is because of my emotional well-being personally. I've been through 4 cycles, and cycles happen. And even though things have been great for 15 years, there's going to be another downturn. And from an emotional standpoint, I went into some really dark places each time we had properties and we had debt, and the banks were chasing us to pay them because when you have a mortgage and you have to pay on time, it's the first thing you got to pay. The bank has no sense of humor whatsoever. So I learned that I just couldn't take the emotional downs of losing money. And I explained this to my accountant and I said, I've done a bunch of deals with debt. By the way, our average remaining debt on our 19 buildings right now is 17% loan to value. So we do have some remaining properties with loans, but 2 out of every 3 that we do right now, we do all cash, no mortgage. So my accountant, I went to him and I said, I want to do deals with no debt. And he said, well, that's ridiculous. Nobody does that. You won't be able to get any investors. I said, well, then I won't, but that's how I'm going to do it. And I called up a number of our longtime investors who've been with us for, in some cases, 30 years, 25 years. And I explained what I was doing. And it seemed really interesting to me that many of them said, you know what? I like that. I like the idea of not losing my money because there's no bank. Especially today, you look at all the newspapers, Wall Street Journal, local business journals, a lot of people are giving buildings back that are these Class A office buildings and hotels. And I don't want to be in that position. And so, yes, it does hurt us in terms of the magnification that you get from leverage that we don't have. But there is a group of investors that doesn't care about that. They just want to make their 8%, knowing that it's going to be consistent. And if there's an interruption, it's temporary and they're not going to lose their money. And I've got 64 of those investors right now who love all cash, no debt.
Yeah, well, especially in this market when other people are doing capital calls and things like that, there's no reason for you to do that because the debt didn't get out of control for you.
Rust Belt Capital is an elite Ohio-based private equity firm with a specialization in long-term, high cash flow multifamily investments. If you're looking for long-term recurring income, you should check out Rust Belt Capital. From their approach to managing risk, to the locations they invest, the product quality they provide, this firm is serious about what they do, which is why the owners of Rust Belt Capital invest their money in every deal they take on. Review their case studies by visiting rustbeltcapital.com. That's rustbeltcapital.com. Once again, rustbeltcapital.com or email investor@rustbeltcapital.com.
Self-storage has been one of the fastest growing real estate sectors for 4 decades straight. With inflation on the rise, it may be the hedge you're looking for. Spartan Investment Group identifies low-risk, value-add investment opportunities in commercial real estate. Their private debt and equity opportunities offer stable monthly payments and predictable returns. And since they put every investment through a 700-plus point due diligence checklist, you can invest with confidence. To learn more, visit spartan-investors.com. I'd like to talk about the importance of tenant selection when investing in this industrial real estate asset class, because you've mentioned, if someone moves out, it's a lot harder to replace a tenant in an industrial place than it is, a multifamily. So Can you talk about tenant selection and how you kind of vet the tenant, make sure that you're getting the right tenant? And then also, could you talk about, is there a tenant in place when you buy these properties typically?
Yes. About 90% of the time, 9 out of 10 deals, there is a tenant. And so when we vet the tenants, when we buy leased buildings, we like to get their financial statements. And we like to interview their executive personnel to make sure we know who they are. One of the most important things is to know how much debt they have themselves, because like us, if there's too much debt, that's what crushes them. And it's also important to know, this one's not obvious, how large their largest customer is relative to their sales. Because we had a printer at one time where their biggest customer was an office supply company. And the office supply company, because of the internet, got hurt badly. And they lost the printing job because they weren't printing catalogs anymore. Everything went online. And the tenant, the printer, called me and said, I just lost my biggest customer. And he was somewhere in the neighborhood of 50, 60% of my business. I don't think I'm going to survive this. And he went out of business. He closed it down. We were incredibly lucky. We owned the building next door, which was owned by an awning company, commercial awnings for banks and restaurants. And that guy, we were in touch with him as our tenant regularly. And I called him and I said, Jim Patton. I said, Jim, the building next door is coming on the market. He said, holy crap, I need it. He leased it. And he put together, because he made these canvas awnings, he put together a frame between the building that he was in and the building that we had coming up, with 2 drive-in doors on either side of this framed thing. It was a hallway over the parking lot with a cover on it and walls and openings on each side so that they could walk back and forth between the buildings and drive back and forth with forklift trucks. Now, Jim was the opposite. He had hundreds of customers. There was no customer that was more than about 5% of his business, maybe Chase Bank, because they would lease a building, and you've seen their blue awnings, right, with their logo on it. That's what he makes. So I knew that Jim was safe because he had so many customers. Also, we buy buildings with national tenants. We have the U.S. Postal Service, which I can tell you is the most disorganized tenant we've ever had. They pay their rent late and they pay their taxes late, and they owe us $130,000 right now. And that's the rent and taxes all together are only $500,000. So they're like a third of a year late. I've got a brother in my business, and he complains to me that his job is chasing the U.S. Postal Service to get rent. They have a package delivery facility that we own. It's you wouldn't believe why would they be one of the worst tenants, right?
Right. That's crazy. Well, you hope they're good for it at least, right?
They are.
So talk about so for investors, what are the biggest risks that investors should think about when they're investing in industrial real estate, especially now because, industrial has been the hottest asset class over the last several years. So does that mean now it's time for a dip? So what are the risks and what is the outlook?
So what you see on the side of the highway in every town, you're in Ohio, right?
Yes.
Okay. When you drive around Columbus, there are so many gigantic warehouses. And what's happened is pension funds have figured out that industrial is really great. Why? Tenants stay and stay. The returns are usually better than they are for various other kinds of asset classes in real estate. The rent escalates every year. It's a very easy asset to manage. You collect the rent. That's about it. If the roof leaks, the landlord's responsible for that. They have to make sure the building's insured and all that kind of thing. But these big pension funds have unlimited money, and developers have a deal with the pension funds. You take our money, you go develop a building on a speculative basis, which means vacant, and try to attract a tenant. And for a long time, Amazon was occupying every building that everybody built. And that stopped, by the way. But as the internet continues to expand, and as there's what's called reshoring, which is companies coming back to the States from China to make products here because of supply chain problems that they learned about, they want to make stuff here. These buildings have just filled up. Like you build it and they will come. You build it and they will come. But it's gotten to a point where I believe that too many buildings are still being built and there won't be enough tenants to fill them all. And they're very large, and it takes a special tenant to occupy 500,000 square feet. So I see that there's going to be a problem with these big buildings potentially at some point. It hasn't happened yet, but at some point. So if people invest in industrial, you've got to remember industrial actually is made up of about 7 or 8 different types of buildings. And the big, gigantic, high ceiling warehouses, that's just one. So if someone says I'm investing in industrial, it's that, but it's also flex buildings, which have lower ceilings, but a lot of office for companies that do technical things. It's also our kind of buildings, which are the smaller, older Class B and Class C that were built in the 1970s and 80s. And then you've got other older buildings, which are Class B and C, larger buildings. So there's so many different kinds of industrial. And yes, I think they're all at risk of seeing the end of the heyday. But if we, by knowing our niche really well, can pick the right buildings, the specifications really matter. If I had to design a building that was the perfect industrial building that would have the best opportunity to be leased or sold quickly at the highest price, it would be 20,000 square feet. It would be a box that would be almost like a square in terms of its geometry. It wouldn't have to have, because it's 20,000 feet, I want one dock for every 10,000 square feet. It would have to have 2 docks, a drive-in door so you can drive a van inside. It would have a minimum of an 18-foot clear ceiling. These brand new buildings go up to 36 feet. We don't need that for the smaller buildings. But here's the really big one. The number one rule in my industrial deals, the number one priority is parking. Because the older industrial buildings, a lot of them only had one car per 1,000 square feet of building. And as companies grew and they added more employees, they needed more parking. And if you only have one car per 1,000 and you grow your office, so your office staff used to have 7 people and now it's got 14. And your warehouse used to have 5 people and now it's got 12. The problem is you're short 7, 10 spaces, and you can't operate your business if your people can't drive and park in their parking lot. So the geometry is really important and the parking's critical. So we look for buildings, and by the way, the parking also has to be in front or on the side, not in the back, because in Chicago, it gets cold here in the winter. So people who have 14 employees in the office, they don't want their people parking in the back, because then they have to walk all around the building to get to the front, which is a 1-minute walk. And when you're freezing, you don't want to walk for a minute. So they have to then go through the back door, through the manufacturing facility, where they may have forklift trucks running around and machines doing things, and it's dangerous. So they don't want their people walking in the back door. So if someone submits to me a perfect building to buy, but it's got parking only in the back, the answer is forget it.
Wow, that's interesting. I never would have thought parking was that big a deal on a industrial building. That's great stuff. Let me ask you this: so for LPs, right? That's who's mostly listening to this podcast. And one of the biggest things that we try to figure out at Left Field Investors is, how do we evaluate an operator? How do we vet an operator to make sure that they're the quality type operator we want to invest in? And so, how do we do that with someone like you, where it's an asset that you're in one asset class and it's a less common asset class? You're in one market, specific market. So how does an LP, when they're first meeting you, how do they vet you and make sure that you're the company they want to invest in? I mean, you've given us all kinds of great reasons why the asset class it makes sense. So talk a little bit about how to vet the operator.
Sure. The best way to vet an operator, to me, is to, first of all, get their PPM and look at it. And I can size up a private placement memorandum, because I've done dozens and dozens of them and I've read hundreds of them. I would size it up like you do. I know you do that too, in about a half an hour. And I would come up with a list of really hard questions. And then I would talk to the operator, and I'd want to make sure that I was talking to the decision maker at the operator, not some investment employee, someone who was hired to talk to people and sort of babysit them and give pat answers that somebody taught them how to answer. I want to make sure that the syndicator can answer the toughest questions, and I mean tough. So what I do is I recommend to people that they get on the phone with me personally, or my son who's in the business, or my partner Eric. The three of us, we all know the deals. And I say to them, what do you think is the most important thing in terms of picking an operator? And they all guess different things. And the real answer is succession planning. If you are an operator and there's one person who knows everything and everybody else just takes orders from them, if something happens to that person, you're screwed. So when you pick an operator, it's like, well, what happens if something bad happens to the operator? So that's the number one question. The number two question is, how do you make decisions? And I like your system in your TribeVest of having a bunch of people looking at the deal and throwing hard questions. We have an 8-person advisory board made up of our smartest, toughest investors. And I have asked them over the years to be on the committee. And we don't make any decisions to buy anything or lease anything or do anything major without having a Zoom call or individual conference calls with the 8 advisors. And Steve Podolsky, who was my original boss 42 years ago, is on that board of advisors. And there's the grandfather of a family that has been with us for decades, and he's on the board. And I've got a fellow in Canada that knows syndications backwards and forwards, and he's on it. And I've got industrial real estate brokers who invest with us in Chicago, and they're on it. And so the decision-making vetting process is really important. And that assures that our due diligence is outstanding, that we've checked out the tenants and we understand the financials of the tenants, that we ask all the questions about real estate taxes and the condition of the building and making sure that inspections have been done and the environmental, all those things. When someone gets finished talking to me, if they don't think that I know more than anyone they've ever talked to in real estate, at least in industrial real estate, then I've made a mistake. I haven't done it right. And it's just experience. I've been doing it for so long but when someone's been in the business for a shorter period of time, asking the tough questions and seeing what they do and how they react to those questions is it. Because you really can't tell from the PPM. It's more of a sales piece and a risk piece to talk about all the things that you can't sue them over if things go bad. It's really, what do they know and how do they make decisions?
That's great. That is awesome stuff there. So now that we've kind of vetted the operator and we're looking at the deal, and you've talked about some of this, how you look at deals, but it's different when you're an LP, right? You're not going to dig in and look, we're not going to go as in depth as you do, obviously. So what are a couple of metrics that LP investors could focus on when they're evaluating an industrial deal, specifically one of your deals?
Yeah. So because I have that group of advisors, I get a lot of really good questions from people who do know how to vet the deal. And what we do is we share the Q&A with the investors. And the Q&A has a lot of really tough questions that most syndicators would want to avoid because they don't want to talk about what's really possibly going to go wrong. And
Right.
Every one of our questions, they're not softballs, they're hardballs. Like, what happens if? And what do you know about the credit of the tenant? And what do you know about the real estate taxes in this area? And what do you know about the neighbors? I mean, who the neighbors are happens to be a very major issue. Because if you've got a bunch of guys that fix cars, you don't want to be in that deal because that's an area that's going to go bad. These areas where they fix cars, I don't want car guys. They're bad tenants. They're tough guys. I've had nothing but trouble with. If you fix cars, you're dealing with people who don't want to pay you and don't agree with you and
Right.
don't trust you. So I want to know who the neighbors are. I want to make sure the neighbors are longtime manufacturers with great employees. It's like things you wouldn't even think of.
Right.
Yeah.
No, that's great. So what's the exit on these? Is it, I assume it's more of a long-term hold. You said you've had some tenants for 15, 20 years. Do you buy these and just hold them, or do you also have an exit plan to sell after a certain period of time?
Our average hold period is 7 years. But if it's a great building, here's a theory that I have. Most syndicators are looking to make money. And the way they make money is they make money on the promote when they sell the carried interest and fees when they buy and they sell things. So churning is very good for a syndicator. Holding long-term is not good for a syndicator because the longer you hold it, the chances of getting a big IRR go down. Because the big IRRs come because you bought it and you got lucky. Maybe cap rates went down or maybe something else happened that was lucky and you got out in 3 years. And syndicators can get rich by being turnover people. Holding is a different thing. It's more of a philosophy or a way of doing business that's completely different. It's almost like you're a family, a wealthy family. And wealthy families don't buy buildings to get in and get out, get in and get out. They buy them to hold them and make the cash flow. Like, you know how important that is. And you want the cash flow to go up every year. So yeah, we're long-term holders. And I'm not ashamed to say that I've had one building at 555 Exchange Court in Aurora since 1990. It's a long-term hold, but our average hold is 7 years because if a tenant leaves, we then very likely will sell the building to a user rather than an investor, because a user sale gets us a 30 to 40% premium over selling it as a leased building for a cap rate, because manufacturers will pay more for a building in the neighborhood when they need to move because it's more of a tool for their business. So our exit strategy is usually to sell to a user for a premium and not to sell to some other investor. Because once you find a great deal, think about, I told you about the geometry of a perfect building. How many are there? Like when you sell that, how do you find another perfect building? So we hang on to them because it's impossible to replace a great piece of real estate. You know, you've heard of these wealthy families that have owned properties for 50 years in the family, or 60 years, or whatever. That's the way wealthy people operate. And so those are the people who invest with us, or people who are not looking for the quick out. And if someone says, Joel, I only want to tie my money up for 3 years, the answer is, well, we're not the right guys for you, because we want to own this great piece of real estate. We just bought 3 properties on the Chicago River. We have 1,200 feet of river frontage, which one day is going to be a condo redevelopment. But for the moment, we have a company called Tampico Beverages that occupies the buildings, and they make fruit juice concentrate, and we have a 7-year lease. And the rent starts out at $7.80 a foot, and it goes up every year. And the question is, how do you replace 3 buildings on this beautiful parcel in this great neighborhood in Chicago with a tenant that's owned by a $4 billion parent company that can never move because the equipment, the tanks and tubes and everything in the building would cost $20 million to move, and their rent's only $1 million a year. It would take 20 years for them to make up the move. So they're not leaving. So, you know, we want buildings like that we can keep long term. And the one thing that I can say is, if an investor wants to get out, if they need the money, I have enough of investors in each deal that all I have to do is send out an email. Hey, Jim wants to get out of this deal. Who wants his piece? And we do something called a Rule 144. The SEC has a Rule 144, which is one investor can sell to another investor, and it's not the same as selling securities. And the only requirement is that they hold it for a year before they sell. And I've matched up party A with party B dozens of times over the years, and it's fantastic. And there's a 1-page assignment agreement that the buyer and the seller sign with each other. We don't take a fee, we just arrange it. So we have a little bit of a trading floor to give liquidity, because in a 20-year hold, if someone wants to get out after 5 years, you got to have a way for them to get out. They can't be trapped.
Yeah. Interesting. So just a quick question on that, and then we gotta go to our final question. But does the person buying it, do they set the price? How do they set the price? Is it just you get whatever the capital you input, or is it, do you reevaluate the price of the building? How do they come to agreement on the price for their swap?
Well, that's a great question. You asked what kinds of things would you do to vet a syndicator? One of them is ask them for their reports. You want to see their prior reports they send to the investors. We send an annual report where we do a high-low valuation of the property in writing. And we actually say, this property, the high is 15 million and the low is 14 million. And that gets published and sent to every investor. So the investor who's selling knows that I think that the value of the building is 16 million on a good day, and that it's worth 14 million on a bad day. And the buyer knows. So the buyer says, I'll pay you at the rate of the 14 million. And the seller says, I want the 16 million. And I say, hey guys, how about 15 million?
Easy, right?
Easy. And so if someone owns 1%, the one guy gives a check to the other guy for $150,000 for his share of the 15 million. And that's the end of it. And in the assignment agreement, we call it acceptance of assignment. I'm not kidding. It's a half a page, and each one signs it, and I have to approve it as the manager or GP. And the money changes hands, and we have to do something called the 754 election, which is a tax thing. so that the
Yeah.
new buyer doesn't get stuck with the old owner's tax liability. It steps it up, like when somebody dies or
Right.
a step up in value. We have to do that. It's a little complicated, but we've done it so many times that our accountants are experts at it.
That's really, really interesting. So the last question I always ask is, what's a great podcast that you like to listen to?
Thoughtful Money, it's called. It's Adam Taggart. He's always interviewing economists about everything in the economy. There's not a lot of talk about real estate. It's mostly about the stock market and the Federal Reserve and central banks around the world. And it's fascinating. He's on about 3 times a week. He used to have something called Wealthy On, and he left Wealthy On about a month ago and did this new thing. And I think 70, 80,000 people watch it. It's fascinating if you like to watch the economy and learn about it.
No, that's great. I've heard of Adam Taggart. I used to follow him a few years back, so I'll definitely check that out. So if listeners want to get in touch with you, learn more about your business, what's the best way they can do that?
Our website is Brit Properties, BRIT with 1 T, properties.com. And it's our website is full of all kinds of information about what we do with the low debt or no debt. And I've got an article that's called Why You Should Not Invest with Us.
That's perfect. I like an operator who gives you all the reasons not to, as opposed to just trying to sell you on something. So that's fantastic.
Yeah.
We will we'll put all that in the show notes. And thank you for being on the podcast. This was fascinating, and it's about time. I've had you on, as I said, I've had you on the radar for a while. Really glad we could connect on this. So thank you very much.
Thank you, Jim.